Okay, hello everyone, and welcome to another Pepperstone live event. I do hope we're live now, but I'm very excited to bring you the topic of today, which is, of course, scalping strategies for quick profits, and more importantly, a deep dive into a little bit of the market and a pretty simple strategy that you can start to apply after today, along with your other concepts. Now, I do hope that that will be pretty exciting for you, and I also want to through all of that because, of course, we weren't able to get it set up straight away. But yeah, let's talk about what we're going to cover today. We're going to be looking at understanding the basics of scalping. We'll be looking at some strategies for identifying and executing profitable trades. And of course, we'll also be looking at some techniques for managing risk and limiting losses. There's also a little bit of tool discussion that we need to talk about. What else do you need to watch out for when you're scalping? Some things for beginners that can really be helpful for you, even intermediate and advanced, and Q&A as usual. Now, if you have any questions, please feel free to ask them. I am reading the chat now, so yeah, feel free to just put any questions in there, and I'll ask them throughout. And if they're anything to do with the topics, then of course we might be able to answer them throughout this session. So, without further ado, let's start with a quick disclaimer, and I'll see you back here in just a couple of seconds. All right. Well, we start things off by a need for understanding. And one of these things is that we need to understand what's going on in markets and, more importantly, how bigger traders actually trade. Now, of course, if we're scalping or we're day trading or even if we're swing trading, we're probably realistically going faster, kind of like more like an algorithm than we are more like a proper positional trader. But realistically, if we're thinking about a bank or a hedge fund or a mutual fund or any of these things, then the way that we see things is that we go with this idea that all markets have huge amounts of money in them. We know the FX market has got trillions of dollars in it per day of transactions, and we have to understand that they're positioning based on all sorts of timeframes, all sorts of reasons, all sorts of things. So what we're more interested in is thinking about markets as kind of the ability for us to judge force. And I think this is a great quote here from Richard Wyckoff. Obviously, he came up with the idea that the market and the composite man being one entity was moving markets in directions, balancing it out to forces of supply and demand and equilibrium. So he said successful tape reading is the study of force. It requires the ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. It's a pretty famous quote. I like it very much. And I think it's a great way to begin this discussion of why you need to start thinking about markets, even if you're a beginner, a little bit differently, and how this can help you to identify better key levels when it comes to scalping in these markets. So let's think about this was if we're entering positions or we're entering any market, how does a bigger bank enter these positions? So let's just quickly go with a line here. And I've explained this in other webinars and other live sessions, but I thought it's always good to start off here. If you think about it, a bank or an institution is not going to be able to execute all of their trades at once. They're going to buy zones or areas. And if a market's coming down to an area they like, they might say, this area here is kind of premium, but they're still interested in it. This area might be fair value and they're interested in it. And this area could be cheap. So as a market comes into this zone, it might start to form price action that looks kind of like this. Now, many of you will know that as a channel or a range bound market or an area where markets are kind of finding a level of equilibrium. And in essence, what's occurring here is larger institutions are jumping in and they're either purchasing extra positions or they're basically selling positions in that market. But they're certainly very concentrated around these levels. Someone is a strong buyer and someone is a strong seller. And it's the study of force that we're interested in. When it breaks to the upside, what could that mean? Well, it could mean that demand is outstripping supply and markets will be moving up. If it goes to the downside, it could mean that the sellers are now very excited and it's supply outstripping demand and the markets go down. So what we want to be thinking about is that large institutions don't just buy one price, they buy many prices. And therefore, as a scalper or a day trader, what we're interested in is understanding the market structure to know whether we're in a larger range bound market. That means we have to go top down here whenever we're thinking about these markets. And then we need to understand that when we're going for take profits, where should we be setting them? And I want to get this into everybody's mind if you're a beginner, that it's better not to really consider going with things like, a 20 pip stop loss or a 20 pip take profit or any of these forced ideas. It's more important to be something like market adaptive. And I think that's one of the big concepts here. You want to be making sure that you're being market adaptive with every one of your strategies. So, how does a market produce the most amount of positions? Well, if we understand that they might start to think of a market like a grid, as in they've got their premium, their cheap, their fair value and their cheap, then what's happening here is that markets might start to rile around or join this kind of zone. Now, once you start to see something, let's just say we had something like this, the market's coming down, bouncing up, coming down, bouncing up, and then it goes for one last final push through. Often what will happen is markets will go underneath a previous zone or above a previous zone. Now, you've got to think about it as, what is a market trying to do? It's trying to get enough liquidity for the big players. And one of the ways that they can get liquidity is, of course, triggering off other retail traders' stop losses. So one of the beginner techniques is really to start to think about markets as less of, you're going to look for a technical pattern or you're going to look for anything else in particular, like, an indication cross or any of those types of things, but more of a patience concept where you're waiting for markets generally to take lows or take highs. And that's something I'm going to bring in later on today in this video, that the idea of using a stop loss hunting technique, which changes the way that you perceive smaller timeframes, whether you're on a 1 minute, 5 minute, or any of these other timeframes. So the market comes down to, let's say, this price here. We'll call it 72 cents on the Australian dollar. We'll call this 73, and we'll call this 74, just for simple sake. We know that the market buys off this zone, and people, of course, get excited about that. Now, what will tend to happen is that often the market will go back to the middling price. So if you had a range that was between 74 and 72, 73 is actually a very solid take profit for these types of markets, these types of range bound areas. The middling zone is, remember, what we call fair value. So as a scalp technique, number one thing is, if you're trading a range, instead of what most people do, which is go all the way to the other side of the range, it's actually better to go for the midpoint of the range. That's usually the equilibrium or the fair value within this kind of bigger buying cycle. And you can already see why just understanding that one thing of larger traders positioning in can help you in defining strategies, even just around range-bound markets. The other thing is, if the market then comes back down and it swings underneath this low, that's going to be a very interesting point for you, because what's effectively happened? Well, at this stage, it could be a breakout. The markets could be breaking to the down low, but you don't know that yet. So if you're a little bit more patient and you wait on those timeframes, you might then see the market reverse. Now, has anyone here in the chat ever had a time like this where the market has made a low, it looks like it's rebounding, then all of a sudden it goes down and it makes a new low, and then about 20 minutes later or half an hour later, it's all the way back above where it was, and you think, what just happened? What just happened to me there? That is absolutely unbelievable that this just occurred. Have you ever had that happen to you? Let us know in the chat. I can definitely say it's happened to me a few times. So with the market coming down into these zones, if the market then turns and it actually breaks past this high up here, what that's actually doing is it's actually confirming to us that this was most likely what we call a stop loss hunt. Now, that doesn't mean that the broker or Pepperstone or anything like that's coming for you. It's totally not that way. It's what it is it's a positional. And it means that basically the market has induced liquidity. And I guess this idea of induction or inducement is a big thing now in a lot of people's discussions in markets. And it's because what happens is, think about this way. If you have a buy order here, as the market actually goes down to down this zone, that becomes a sell. So the buy becomes a sell, and who's going to take that other side? Well, if you think about Wyckoff and his concept was the study of force. So it could be a bigger player coming in and saying, well, thank you very much for that sell. I'm going to take the buy now. Thank you for your liquidity. Thank you for your order. You've now given me the ability to have more position in the market. So that's often why these types of things do occur. Now, why this is important is because when you see sequences that are simple like this, even in scalping, it can underpin an incredibly good strategy that can really help you out when it comes to making better scalping decisions. So, as a beginner, you might come in and you say, okay, what is one of the core foundations that I want to learn? I think one of the core foundations you really want to learn is that you need to think of markets as positions. Big positions are being placed all the time. If a market goes up and then it starts sitting like this, and it forms, many people know as a range bound or channeling market, there is something going on here. There is a fight between effectively the bulls and the bears, or supply and demand. And when that market breaks to some side, it closes, it generally will go slingshotting off in that direction. So we have multiple different techniques that we need to learn. We need to learn how to follow the trend, and we need to know how to train the range bound. And I've got news for most traders out there that range bound markets actually usually make up about 7 months plus of the year. So generally, we're not in heavy trends throughout FX, throughout stocks, throughout commodities, any markets. Now, of course, gold right now is on fire. So we might look at that later, but it's not always the way. Gold consolidates for a very, very long time as well. So why this is important is because if we understand that if a market came down to this low here and it did that, and then it goes back into the zone, this could be considered also a false break. So effectively, we would have a stop loss hunt, a false break, which would induce sellers, and those sellers would bring in, of course, the other side, because remember, there's always an equal and opposite side when it comes to markets. And you tend to then get this breakthrough here. And this is when you will know more as a trader, oh, I see what they did then. So remember, this very simple sequence of events is actually very different to what most people will be talking about in markets. And that's because when you consider it, we have a low, we have a high, we have a lower low, and we end up making a higher high in that structure. And that's very important. We make the higher high in that structure. Now, I've got one where it's a little bit tricky here, and this changes the rules a little bit because it shows you why you've got to be very, very careful. So we've got, if we think about it here, we've got a trough, a peak, a trough, or lower trough, lower peak, lower trough, lower peak, lower trough. Now, where do we actually get the higher peak? Here. So what's important is when you're analyzing this, I'll give you a bit of a top tip today. The sequence must be that you wait and you're very, very patient until that last peak is taken out or that last supply is taken out. Now, there's a lot of complexity behind this actually is understanding. But in general, if you're looking for that last peak, we'll draw it here as an example. So I'm going to give you an example on the screen. Let me go to a black screen here. And then let me actually draw you up one. So if we had a market that does this, it goes down, then it comes up, then it goes down, then it comes up like that. That is actually not going to show you yet that the market has turned and it has actually grabbed liquidity down in this zone. Okay. And this will make sense to the simple strategy we're going to talk about later on. It will generally not mean enough because what's happened here is this, when it broke to the low, on whatever time frame that is, whether it's a 5 minute, whether it's a 1 minute, whether it's a 3 minute, this is valid across all time frames because the markets are fractal in this stage. This is what we call the supply. So the market is coming back up to this position, and we know that there were sellers there before, so we have to assume there's still sellers there. So it could just instantly go like this. So the trick here is to understand that we must take out that level of supply, or on the other side, we must take out the level of demand. And I've written a whole course about this, and it's obviously a very important base concept. But if you're going to take one thing away from today, it's understanding that there is a sequence of events which tends to create what I call the fastest ability to create as much liquidity as possible, okay, for the composite man, which is effectively just all of the market participants trying to get involved in a market. And that's going to be one of the most important things as a scalper, as a day trader, that you need to understand. It's not so much about you understanding patterns and all of those types of things. It's more about you understanding the dynamics of how markets are actually created, and therefore realistically more about where the orders lie in the system and how bigger players are actually buying on the higher time frames and how you can possibly see some of those events occurring on smaller time frames. So let's jump over to the charts here and we'll look at a very simple strategy that you can potentially apply to your charts. Now, it's not always going to happen, but I just want to kind of bring it up here so you can see it. So this is the Australian dollar about 2 days ago. Okay. So the Australian dollar 2 days ago, very, very interesting level. And what you might notice here is I've set it up so that we've got a little high wick over in this zone. So this is a massive candle, huge candle, big daily, nice. Looks good, yeah? Now you might assume, okay, well, the market could keep going bullish. Absolutely, it could. But what you're looking for is a pretty simple concept, and it's going to bring both of these things together. So I've drawn a little red line, and what that red line does, I'll just quickly show it. I'll bring it back actually, and we'll keep it really simple. So we'll go back and we'll actually put down, I'm just going to use Command J here in TradingView or Alt J if you're using a Windows PC. And this is going to show you here the previous high wick. And that's important because we know that during this daily session, we had the low. It's this simple. So we had the low, we have the high, and of course, we have the open and the close. So that high wick is what we're interested in, and that low wick. Now, we don't need to mark this low wick because we're really far away from price at that point. But then we go into something like a 3-minute chart. I like 3 minutes. I find it to be a pretty good time. And what we're looking for is we're looking for a market that kind of goes above that level potentially during the session and then reverses back down. And why we're looking for that is because when we think about what the market's doing is, and I want everyone in the chat to answer this, if we have a daily close and we have a daily high, what do you think a lot of retail traders and a lot of people out there would do if we go to a new higher high? And, you know, we've got Mark here in the chat, Arshad, we've got M, Anthony, a few other people. So they're hopefully somebody here can answer this. But what do you think might happen if we break to a new daily high, like we did during this session over here? What will that trigger? Well, it's going to trigger a few different things. The first one is people that have stop losses may have stop losses above the high. So effectively, their stop losses are triggered. The other thing that might happen is a lot of people like to buy momentum-based trades. So, which is right, you know, sometimes that's going to work. But I'm here to tell you this is pretty good percentage trade if you're looking at it along with some of your other things. People will also look to buy. So this is a perfect opportunity for markets to do, you know, a false break or a fake out. And you tend to see these fake outs happen a lot into London in currencies, into an opening of a session, whether it be London, whether it be Asia, whether it be New York. You tend to see these types of things happening. And that's because it's a build of liquidity when bigger players and banks and hedge funds and everybody else opens for that session. They all come into work. Oh, I've got to go and wait, I've got like $1 billion I need to hedge off. Well, I need to get some liquidity. So how am I going to do that? And then kind of push that market around. Now, that's a simplification of what's really going on, but that's in essence what you're looking at here. So the market goes above this zone. And if you're looking for sequences, you might actually be able to spot it if you're eagle-eyed. So the market goes high here, has a low here, and it goes to a higher high over here. And then the market goes to a lower low. Now, once that occurs, what you might notice is the market comes back up and then it just goes boom back down. It's the sequence that really is important. It's the sequence and the understanding that the market has broken to a critical high. Now, a daily high is only one measure, but it's certainly a pretty solid measure because most people look at daily candles, even bigger players look at them. Weekly candles, very key level. Monthly candles, even more key because bigger players look at those as well. But for a scalp up, every day you get a daily candle across many pairs. So it's not that every time it breaks to a higher low, it's going to do this. It's just that when you start to think about the way the market's doing it, you can see it's found some nice resistance at this high. It's struggled through. It's got this kind of low here that it come down to, and then it shoots through and it makes a new high, and then it breaches down. So if you think about that, it's the sequence that we had on those charts before. It's a very simple concept, but it's a little bit different, little tweak to what you're doing. This triggers the buys, this triggers the stop losses, and then the market goes the opposite way and then it pulls back, which it often does. There are ways to kind of figure out those types of areas and where it's going to go, and then it rejects. And you'll notice that actually for the rest of the session, it rejects. Now, that doesn't mean it's always going to go this far, but it's certainly quite solid to believe that it might go from this area up here. And of course, you'll know as of here that you're probably going to look at the short. And for a scalper, from here to something like this structure over here, or even this structure in here, is very likely to occur during that session. Now, why? Because it's the next level where we saw some form of consolidation in the markets. Like if you look here at the left-hand side, and I don't want to make it too much more complex than this today, but if you look at the left-hand side over here, you have some form of small range where the market then broke out and went above. So in essence, what's occurring here is the market has triggered at this point, a nice stop loss hunt, and now it pushes towards that direction. You can see why it picks up here initially. That's why the buyers come back in, because some people will be taking profit. Some people will be buying based on the demand that they're seeing on the left-hand side or what they perceive as being strong demand. I personally wouldn't buy there, but I can see why people would. And it's a solid level to be considering. Now, is that fast? Well, yeah. I mean, if you pick it up on the way back, you can see how quickly the market comes down to this. And it's not the only time that you're going to see something like this. If you go back through your charts, again, looking at the daily and combining that kind of scalping based technique, or I call it kind of like the first time frame change of trend, or some people call it other things. It doesn't really matter. What it is it's a build of liquidity, the fastest way that the markets can build liquidity in one direction or the other. So Stephen says here, great example and explanation, Tom. Nice pump and dump on the odd after interest rates. Yeah, well, it often happens around these periods of news. So you often see these types of things coming through. Arshed says here, are you using some kind of SMC, like 5 minutes, 1 minute? Yeah, well, of course, we're looking at a 3 minute here, but you don't want to ever just consider like a 5 minute or a 1 minute or a 15-minute candle or any of those things. You must bring it back to a higher time frame, because remember what we started with today. We talked about the idea that markets are building positions, and the way that they're building positions is not based on a 1 minute, 3 minute, 5 minute chart. Sure, there's a lot of moves going on there, but it's usually algorithmic or other big powerful things. Instead, the best way of looking at it is, if they're building positions on higher timeframes, can we be fast and nimble on smaller timeframes to take advantage of that? And that's just one of the strategies that you can apply. Daily levels, it's a very, very critical zone. So say today over here on the pound, what may I have marked? Well, I may have had marked this up in this level. Now, if we'd seen that level get taken and the markets went like this, and then they went like this, well, that could have been a keys thing for me to then zoom in on a 3 minute chart. I could have had to set alert there. It's not that hard to set alerts, is it? Now, I'm not saying it's always going to work. Of course, nothing is 100%. But you might notice that even at this point, you're starting to see some of these shifts. Now, you can probably start to spot them. Notice here, we get a high, we get a low, we get a higher high, but we don't actually get the lower low. Over here, we get a high, we get a low, we get a higher high, we get the lower low through that structure, then we pull back and we actually go short. So if you'd shorted there, oh, well, it may have worked out for you. If you'd then gone long here on the pullback, then it may have gone okay for you. Now, there are more complications to this, but it's a beginner, so we have to understand this is the start of creating some kind of structure. But I always say it's important to always have a great base. Whatever you're doing, if you're using RSI or moving averages, you have to have an incredible base there. So this is something that I'm always looking at in these markets. What is my base formation? And I always believe the best bases are usually some form of price action base, whether that be a schematical base, whether that be some kind of bigger swing base or some pattern base or any of those types of things. It is better to have that as the core structure of your scalping system. And then you can apply strategies. I mean, a simple strategy might be, okay, well, I see this, and when that occurs, I want it to cross a certain moving average. Maybe that moving average is a 20 moving average. Maybe that moving average is a 50 moving average. I don't know. You can pick whichever one you want. I mean, it's not particularly the way I look at it, but it could work. Maybe you want to combo it with RSI. Maybe you want to combo it with stochastic. So all of these types of things is pretty important. Rob says the Pepperstone chart wasn't showing that sequence. Well, I'm not sure. You'd have to look at it again there, Rob. But yeah, it should. I mean, basically, price will have hit these certain levels, and it, across feeds, and of course, Pepperstone has a huge liquidity feed. That should price something like that. The original BTC says buy before, absolutely. So if we have questions, feel free to put them through. But this is kind of like the essence of something that I want to talk about. So if we have price action sequences like that, should we stack some concept on top? Well, it's my belief that when you're a beginner, you want to kind of start stacking a few reasons. Like anything, you want to create a trading plan. So we mentioned before that you might start with, let's call it a sequence of transactions. The other thing is that we then might say, okay, well, we want to build positions, whether it be supplies, whether it be demands. We want to understand the market structure a little bit better. Where are they building positions, the bigger players? So I know when I want to go for less take profits and when I want to go for higher take profits. Because what would happen here if we had a daily candle? Let's say we apply the daily candle strategy and we have some nice bullish closes and it's kind of in an upward trend. And then the next day goes underneath and then it does our sequence like this. So if we see something like that and we go, oh, I want to long it here, I want to buy it, could that be more powerful? Well, at this stage, it looks like we're in a strong upward trend. So rather than taking our shorter take profit scalp, because we're in the direction of the overall trend at that point, they say the trend is your friend. If you've ever, heard that saying before in kind of scalping or day trading or any of those types of things. Well, this would be probably a period of time where you might want to hold the position a little bit longer. And I'll give you a bit of a top tip to generally define trend if you don't know how to do it. It's always great to use a 200 moving average, and you can actually apply that onto a daily chart. And you can just look if price is above the 200 or below the 200. Now, that's not foolproof, but it's a great beginner strategy to at least give you a bit more of an idea of the overall driving trend, whether it's bullish or bearish. The 200-day moving average, and then whether the price is above or below the 200-day. And I used to use that a little bit for people that couldn't read the charts properly, but it's a great beginner just to see the overall trend. What's the trend direction? If price is above the 200, well, it looks like most people, most of the big players are buying. That means that if you get into buy style scalps as opposed to sell style scalps, there could be a chance that you get a little bit more run in them. So you can leave them on a little bit longer, descale your position, risk manage it a little bit differently. All of these things can be done. So that's a good little tip whenever it comes to this. But understanding supply and demand, which we've done plenty of sessions here, so I encourage you to go and have a look at some of the other Pepperstone work that we've done. We've got some great, extra stacking that we can do with our schematic or with our first time frame changer trend, or again, whatever you want to call it, the sequence of the way that markets switch. So with supply and demand, what really it is all about is markets moving from, I believe, equilibrium to equilibrium. Effectively, when a market breaks through a level, remember, if we think about what Wyckoff was saying, Wyckoff said it's the study of force. When a level is consolidating for a while, there is basically a neutrality in that market. There are sellers and there are buyers. When the market breaks out to a upward trend, it goes into a trend itself. And that means that basically demand is outstripping supply. And we tend to move to the next level of equilibrium. Now, you can start to figure this out with more knowledge in the markets. But really, in essence, when you first come in, you look at markets as any type of structure. And let's actually look at a chart right now. We'll use the pound here, and we'll go over to the daily. What you might notice is that at the moment, there is a possibility that the pound is trying to break out of a structure. So this has been a very big structure. If I was buying the bottom ends down here, where would I like to take profits? I'd love to take profits in the middling zone. Remember, here is the premium. Well, basically in this case, because we know it's going up, we didn't know which side was the premium or fair value, but fair value here. And then probably this was going to be the premium and this was going to be the cheap because we're trying to, as we know, the market's now theoretically breaking to the upside. But if this market over the next day comes right back in, then where would we expect it to move to? Well, it makes some sense to move potentially to the middle. And there are other tools that you can use for this. But we're effectively in a trading range bound market. We know that. And we have been for a while. And a good top tip to kind of figure out when you're in one of those is to count it out. 1, 1, 2, midpoint, you're in a range bound market. And in fact, you can actually start the 1 there if you wanted to. So 1, 2, or 1, 1, 2. And then when it goes here, you're most likely in some form of range bound. Either or works. 2, 2, certainly you're in a range bound market. As that goes back, that will absolutely mean that you now know you're in structure. And it's a great kind of like little cheat technique that you can use. So you can see we've been in some great trends recently, but on the smaller time frames, there are plenty of areas where we've been range bound for a period of time. And once you start to see that on, let's say, the 4 hour, the 2 hour, the 1 hour, which you should always be looking at as a scalper, it can help you to define where you could take profits. So let's say you came in on this particular day here, and you can pretty much see there is a similar sequence in here. You might say, okay, well, this is on the bottom end of the range. I think a great take profit target would be something like this and this. And that would make sense to the previous supports, the previous supplies, the previous levels and structures that you're seeing. And that's the next step to taking a strategy to the next level, is being a market adaptive and recognizing the zones in these markets that are actually producing price. So they're actually where markets have stopped before. And you'll find that often they'll be the levels where you'll see some take profiting. So let's say you bought down here, an obvious location would be the middle of this structure here for take profit. Now, the middle is just a very basic simplification, but can you see this is the structure? The market comes up and notice where it first stops, right in the middle, bang down. So that could also be a place where you might start to look for scalps towards the short. If you see 1 minute, 2 minute, 3 minute kind of turnarounds, the middling of these areas is where no retail traders tend to look, because we're always looking for the extremes on both sides, the extreme high or the extreme low. It's what you're taught most of the time. The middle can be also incredibly powerful, both for a take profit targeting and also potentially even for reversals. So that's something that I guess I wanted to bring in here. So the daily technique, great one to apply in your strategies and start to think about a little bit better. Go and I encourage you, go and have a look at some dailies, come back, put some comments here if you've had a look at some of those. But I do think that that's something that I would apply with that basic scalping strategy, which is just looking at the first time frame changes of trend of how a market builds some form of quick liquidity. We also always want to think about it as supply demand. I encourage you to go and look at some other sessions. We don't have time today to go through it all, but we do need to understand this very big thing. Retail traders are the small fish in markets, and we will not generally make prices rise or fall. It is a larger trader or larger group of traders that have decided something is not currently at fair value and it needs to move to the next level of fair value or equilibrium. So in Forex, commodities, stock markets, big banks and institutions will also never generally be able to place all of their positions all at once. So they use techniques to create liquidity. It's pretty much that simple. If we create liquidity, then we have effectively done a great job of being able to position ourselves up. Remember, put yourself in their shoes. You might want to trade a small amount of money, a few $100s, a few $1,000s, a few $100,000, even a few $1 million. In the world and scheme of FX or any of these markets, they're dealing in trillions and billions. So because that's the way the market's moving, it needs to create a lot of liquidity. I mean, imagine how for every buy you put in, there is an equal and opposite sell going on in markets. That's always the way you have to think about it. It just depends whether there is a sell at that price. So never assume whenever you look at candles, a little bit of a tip today, that if you see a giant candle, don't assume that that giant candle holds a ton of orders or a ton of volume. You'll often see a big candle and you go, whoa, look at that thing. It's massive. That must be a big player moving. Well, it probably just means that there was nobody also selling during that time. And I've got a way of actually proving that to you. Just so because I think it's such a great tip. If you go back a few years ago and you're looking at things like the Australian dollar here, you might notice there are some. Well, this is not the Australian dollar. We'll pull up the Australian dollar here. You might notice that there are sometimes some very large moves. So here's a classic one that happened in 2018. I always bring it up just for what happens around December into January. Now, can anyone guess what this is? So we're looking at a weekly here. But when you look at this, does this candle mean there was a lot of trade volume? And I'm going to ask this to the chat. Anyone out there in the chat, do you know whether that candle equals a large amount of trade volume? Let me know right now. I'm really interested to see whether you know. I'll give that a couple of seconds. By the way, if you enjoy today's session, please remember to give it a thumbs up and let Pepperstone know you like it. We will be doing a special one, I believe, next week as well. So stay tuned for that. Tyrone will be joining me as well, which will be fantastic. So he's a little sick today, but he'll be coming in. Mark Reeder says, like gold last night. Yeah, absolutely. Very similar to gold last night as well. And that's Gecko. Trent says no, and Silverson says no. That's right. So we don't know that was a large amount of volume. It was more the time of year. So if you actually look at it, it was basically New Year's Eve. Now, who's trading on New Year's Eve? Not many people. So what's happened is there's been effectively an algorithmic attack on the markets, which can sometimes happen, and during these thin periods of liquidity. And they've pushed the market down, and they know it's illiquid. There's no orders there. So in a few seconds, it instantly goes down to this price and then instantly gets bought back up because, of course, it was not liquid at that period of time. Now, that's nobody's fault. It's just the way that markets work. And that's why you'll sometimes see that in the news when they're worried about it. So in one day, the Australian dollar went down really heavily, about 3.89%. So that's a massive amount. It went from 70 cents all the way down to like 67 cents. So 300 pips, and then reversed it all again. And that's just due to that period of time around New Year's Eve into the start of January being in a liquid event. So never assume that a large candle means that there's a lot of trade volume. And that's a top tip, whether you're a scalper, day trader, whatever. What you're looking for instead is the structure of markets. And I think that's what I wanted to really get through to everybody today. Start thinking about what is your core structure for your business plan, which is, of course, your scalping technique. Start to look at markets more as how are they positioning? I think that's a really great beginning technique to start off with. And then start to think about daily candles as well. Bring daily candles into your analysis. What happens if a daily candle is broken above or below? The way that the market reacts to that could be incredibly important for you. And you want to be like a praying mantis. You know, they chill, they sit there. You can basically not see them on the leaf, and then all of a sudden they strike. And that's what you want to do with scalping. You need to be fast and nimble. You need to have replication. The number one thing that brings scalpers undone is overtrading. That's where, and I'm sure someone's done that. Has anyone done that out there in the chat? I'll put my hand up. I did it. When I first started, I way too many trades, 20 trades in a night sometimes. It's just too many. What instead you should need to do is you need to have the patience to react to the market showing you what it's doing and not necessarily always predicting in the market. Oh, I think it should go that way. Well, I don't really care what you think. Neither do I care what I think. It doesn't matter what we think. It matters what we're seeing. What is the market storyline? So start to think of markets as building positions each way. And where would you used to place that stop loss when you first began? Where would you think that would be logical for that to happen? Start to think about that, and you'd be surprised how that can make a change to your scalping systems. So yeah, I'll answer a couple of questions here, but that's one of the things I wanted to get through today. And I think that could be a big one. Stephen M says, amazing wick, but no volume below. Pretty much, Stephen, that's correct. And Robbo says, robot candle. Yeah, that's correct. Fard says, why does the spread become so big when the market is not liquid? Well, think about that one logically. If we consider, it's a great question, but it's because there is no orders on each side. So if you were loading up, let's say, a price, let's say here you have the Australian dollar. What in essence spread is, it's the difference between the bid and the ask. So you've got one price down here and you've got one price up here. Now, usually they're very close together. So they'll be within very close levels. But if there's no ask or there's no bid or they're very, very wide, in stock, you'll see it all the time because you'll load up a chart and you'll actually see it. In the MetaTrader 5 platform, you'll be able to right click, go to new order, and you'll actually see the bid and the ask kind of like compressing and moving past each other. That's what liquidity is. What tends to happen around news is you see a massive spread widen because there isn't the markets are moving so quickly that all the liquidity gets eaten on one side as all the robots pile in to try to get the prices and the new level that they're going to be moving to. And that's why you'll often see what will happen around news will actually be markets move the wrong way first, which is often the way I say. The first move is the wrong move a lot of the time. And then they'll move the opposite way. And you think, what just happened? It makes no sense. What is this? Is this some kind of like scam or something? You look at it and you think, what is going on? And that's because, remember, trying to perceive this, and this is not what a scalper should do. I really don't believe, and I'll just say this here, that scalpers should be interpreting news. And that's one of the things I wanted to bring up here as a top tip. You need to know when news is coming out because it's going to create those huge bid asks, which could get you into massive trouble as a scalper. So you actually want to avoid the news and instead trade after the news. How about you have some patience? You possibly react instead to the news once you've let it all settle down and you don't try to predict the move. Instead, you wait until they do something a little bit more sneaky and then you see that. What if they took the daily high? I'll leave you guys with that one. So we'll answer the final questions, but I thought that would be a good one to answer there. Bill says, yes, I can overtrade sometimes. Most scalpers do, unfortunately. It's why you have to have regimented business kind of concepts here. Bill says, any more tips on higher time frame candles? Look, there are so many, but of course, today I wanted to focus on a really basic one, which is daily high, low wicks. And that's Gecko Trent says, does the CLS, DTCC, and Fed wire have any way of not taking each other's liquidity positions so that we don't get caught up in a sweep? Yeah, okay. I mean, basically, the way I would think about it is when you're I'm not really too sure why you really need to worry too much about that. What we're looking for instead would be being patient to see these kind of liquidity issues occurring in markets, or these stops or stop loss hunts or whatever you want to call them, or inducements. Because if you then wait for those to occur, you can then react to those zones. And I don't really think you need to worry too much about getting caught up in their sweeps or anything, because you ideally wouldn't be as a scalper. You would instead employ a strategy that would be based around recognizing those setups instead. It's going to be harder. You're going to have to be way more patient, but I think that's definitely a good way of thinking about it. All right, everyone. Well, thank you so much for joining us. Sorry for making you wait round at the start. I do have a quick disclaimer on the back end, but if you enjoyed today's session, please make sure to give it a thumbs up. Next week, I believe we're coming back at you, so stay tuned to the Pepperstone channel, subscribe, smash the like button as well. And yeah, we'll be bringing you a whole bunch of new tips because we're going to be doing this in a little bit different format. And I think you'll really enjoy it, where we have 2 to 3 really big topics. We're going to go through those, and they're going to be very concise and brought really, I think, to a point where they'll give you some really excellent value out of each one of these sessions. I do, though, hope you've found some value in today, and I'll see you next time. Bye for now.